So I last evaluated ASML stock on October 15th, where I rated the stock as a hold, and I told investors that the price didn't look like an attractive buying opportunity. So fast forward 1 month, and the stock price is down 6.5% over the previous 30 days. And so I wanted to revisit this stock now and see if my hold recommendation still holds or if I'm upgrading this stock to a buy based on the recent developments and change in valuation.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So one of the things I've liked about ASML's business is the excellent revenue growth over the previous decade, where it's increased from 6.8 billion to 37.8 billion. That's good for a compounded annual growth rate of 19.2%. What's more, the leading edge technology that ASML is selling is only provided by ASML. Second place is considerably behind. And so it has considerable pricing power. It can increase revenue just by increasing price, but it's also innovating and delivering next generation technology that's improving capabilities for its customers. By the way, its customers are some of the largest semiconductor manufacturing companies in the world, including Taiwan Semiconductor Manufacturing, Intel, Micron, etc. And so it has relatively few customers that spend hundreds of millions of dollars per machine they purchase from ASML, and this helps them manufacture semiconductors for their customers, which include Apple, Nvidia, AMD, etc. And so the whole supply chain for artificial intelligence is booming in terms of demand because the rising effectiveness of AI is creating increasing engagement from end consumers. OpenAI with ChatGPT has close to 900 million weekly active users. Google's Gemini is approaching 700 million monthly active users, and the engagement on those platforms is increasing. Enterprises and institutions worldwide are spending billions of dollars to enhance their AI capabilities, all of which is facilitating growth in the semiconductor manufacturing industry. But some headwinds have hit ASML in recent months, first of which is the increase in trade barriers, which makes it more difficult for ASML to sell its products to worldwide customers. It has customers in China, it has customers in the United States. It's more difficult for ASML to sell into each of those regions as a result of increasing trade barriers. Furthermore, it's making it more difficult for ASML's customers like Taiwan Semiconductor, like Intel, like Micron, which have had to scale back their investments in new technology because of the recent headwinds and investor concern about an AI bubble, about companies spending too much on the development of artificial intelligence. Another thing I've liked about ASML is the company's lucrative cash flow from operations. Over the previous decade, it's been volatile, but above 19.8% at the lowest and reached as high as 58.3% during the pandemic, during the lockdowns, when demand for its technology soared. In recent months, it's held at 33.5% over the trailing 12-month period. Perhaps more importantly for ASML is its return on invested capital, which has increased from 15.4% to 24% in the most recent trailing 12-month period. This measures how good a company is at using investor money to build new products and services that generate profits and cash flow. What you want to see for a company is the return on invested capital is above the company's weighted average cost of capital. I calculate a company's weighted average cost of capital as part of my proprietary discounted cash flow valuation model. And for ASML, I calculated a weighted average cost of capital of 13.97%, which if you go back and compare with the ROIC of 24%, you can see that the ROIC is well above the WACC, which is a situation where the company is increasing shareholder wealth. And to make that situation even better, the company's ROIC has been above its most recent WACC, going all the way back to 2016, where it was at 15.4% at the lowest, which is still above the 13.97%. So it's not like it's a new scenario for the company to exceed its weighted average cost of capital with the return on invested capital. This is something the company has been doing for more than a decade. Furthermore, when we look at the company's discounted cash flow valuation, I calculated a fair value for this business at $688 per share. The current market price is $976 per share. So using my proprietary DCF model, this stock looks considerably overvalued. However, when I go back to fiscal.ai, which is the source I was using for all of these charts, they're my preferred data provider, and you can see a link in the description for their services. When I evaluate the company's forward PE and forward price to OCF ratio, they look fairly valued at a forward PE of 32 and a forward price to OCF of 31. With the company generating this level of revenue at these levels of OCF to sales, with this level of increasing ROIC and a tailwind from the rising effectiveness of AI, I think these valuations are fair for ASML. Comprehensively, though, when I look at valuation, including both the market multiples method and my proprietary DCF method, I come to a conclusion that the stock is slightly overvalued. And so, given the overvaluation combined with the near-term headwinds the company is facing, I don't see any urgency to buy ASML stock right now, so I'm going to reiterate my hold rating on this business.
Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.